All right. Hello, everybody. Thank you for joining me. I'm Jay Kaeppel, Senior Research Analyst at SentimenTrader.com. And as you can see, it's going to be a walk through our website. Now, as I started preparing for this, one thing I found is that there's no way to get through the entire website in an hour and make it useful. So this is probably going to be part one of at least two parts to get through a lot of things and make them useful. So what I want to focus on today, going through some of the routines, mostly under the indicators section, is how to look at indicators, how to find indicators, and also trading systems. In my mind, there's a difference between indicators and trading systems. A trading system generates an entry signal, and then there's also something for an exit signal. An indicator, to me, offers weight of the evidence. In other words, it can say, hey, the market is bullish right now, or it should be bullish in the next 12 months. Doesn't necessarily tell you when to get out. Okay. So we'll see more of that as we go along. So what I want to do is go to our website and very quickly the dashboard, you get news announcements. You might want to take advantage of this concierge setup service. If you have an idea and you're not sure how to make it happen, take a look at that. We can help you out with that. I would definitely look at these videos if you haven't seen them it's basically from an old video of mine, older one, on how to get through, how I use it on a daily basis. Daily report gives you a summary, and then of course we've got our research notes. You can also access research notes over here. So if you click here, that'll give you an archive of everything that I've written. And also, especially if you're new to the software, I encourage you to go through these videos, tutorials, and then go back through maybe some of the webinars. You're going to learn a lot. It's going to cut your learning curve time way down, I promise you. So where I want to start today is with the stock indicators list. And we're going to spend some time here. As I said, as I started going through this, I want to make it not only useful in how to examine indicators and trading systems, but also related to today's markets, kind of make it a little bit functional. So the good news is we have a lot of indicators. The bad news is we have a lot of indicators. So if I were to scroll down, I would scroll down about 31 times before I got to the end of this list. So obviously I'm not going to go through every single one. I've kind of highlighted some, or I'm going to highlight some that I look at a lot and use that to show you how to analyze indicators. Now, I'm going to start with the American Association of Individual Investors percentage of bears. They do a survey every week. And here's a couple things to note about indicators. Not every indicator is a buy signal. Okay, if it gives a signal, that means I look at indicators as weight of the evidence. All right, not as necessarily an automatic buy signal when you see a red dot that we'll see here in a minute. Also, not every squiggle of every line means something. A lot of people like to really jump ahead and say, well, it looks like it's going to go up or it looks like it's going to go down. Our goal is to be as objective as possible. So let me give you an example of a quick and dirty way to look at this indicator. So you can see there's a few extremes up here where the vast majority of respondents were overly bearish. So how can we use that? Well, if we click on backtest this indicator, the indicator comes up, and I'm going to go to all and say, let's go all history. I just want 1 week at a time. And I'm going to say, I want to know if it crosses above 61%. I picked that number for a reason, but for the first time in, let's say, 6 months. So I say 6, set it to months instead of weeks, and I say exclude overlapping observations. That way, if I get a signal one week and then the next week and the next week. I'm only going to get the one that shows up, the first one in 6 months. So when I click that, it starts running, and what you see are red dots. Now, like I said, not every red dot that you see in an indicator will necessarily be a bull signal. But this one is interesting. This is a very rare type of signal. In fact, some would argue that it's too small of a sample size to mean anything, and statistically that's correct. But it's still worth noting because one of the things I always look for is win rate. Now, that's a personal opinion, but what I want to know is what are the odds, historically speaking, that this is going to work out? And what you see from this one, 1990 in October, 31% higher a year later. March of 2009, after the bear market was finally over, that's when they all got bearish at once. That's why we follow sentiment, up 57%. And right now, it's up about the last signal, April, right before the tariff tantrum. The S&P is up about 22% from that level. So this is just one way to look at this indicator. You could use a lower number and you're going to find more signals. Okay. So again, these are meant to be examples, so I'm not going to dwell on any one indicator for too long because I have a lot I want to cover. Aggregate signal model. That's one of the most important ones. Almost every webinar, I end up referring to this one just because I think it's important. So I'm going to say all. Another thing I find helpful is to come down here and click logarithmic so that it kind of gives you a little more ability to read the top chart, the price chart. And the theory here is if this indicator drops below 0.45, it's unfavorable, and above 0.45 is favorable. Okay, so that makes good sense. And if we look at where we are right now, we chopped around a little bit earlier in the year, but we're firmly in favorable territory. Now let's go over to Backtest Edge, and there's a couple ways you can do that. You can either go to Tools and click Backtest Engine 2.0, or you can go to My Services and click Backtest Edge. And so what I'm going to go do is scroll down. I already have a list of tests, and I'm going to start typing in aggregate signal model and find the one, which is this one, aggregate signal model 0.45. Let's go inside and take a closer look at what this is doing. It's very simple. If I go to setup, so all I'm doing is I'm setting up, I want to look at the S&P, if you want to do all history, you can go all the way back. Otherwise, if you come down here, we're under all history and click custom, you can set a specific starting date. So this one is 1968. I gave it a name and I selected aggregate signal model from the list. If it crosses above 0.45, that's an entry signal. Crosses below 0.45, that is an exit signal. So now we're actually talking about a trading system. We have an entry and an exit. And then let me come up here, kind of zoom in, make it a little more viewable. And now here's the interesting thing about this type of approach. It can give signals that hold for a very long time in an ongoing bull market. In the interim, you can get a lot of choppy signals along the way, right? So if you're using this for 100% of your money, you're going to buy here, sell here, buy here, sell here, etc. So maybe you want to do that, maybe you don't. That's your choice, but it's important to understand for our purposes today what it's doing and what it means. So again, not every red arrow means, oh my God, the market is about to crash. It just means this indicator is giving us unfavorable weight of the evidence. And then if I go to results, just to kind of give you an idea on this one, Interestingly, it's only in the market. Well, it's in the market 83% of the time, which is good. The win rate is only 60%. Why is that? Well, you already saw all the ins and outs that can happen every once in a while. But the average win was 42%. The average loss was only 3. So when we look at the equity curve, and in fact, when we compare it, the blue line here is the equity curve, the hypothetical equity curve, growth of a dollar using the strategy I just showed you versus the gray line, which is buy and hold. So you can see the advantage here. Okay, so that is aggregate signal model. That's another one that I follow. Let me scroll down a bit. Something I look at a lot. If you read my notes, you'll see it often. Corporate Insider buy sell. Now, there are different services out there. We get our data right from Bloomberg. And one thing I found is some services look at all insider buying and clump it together. And I have not found that as useful as breaking it down into a particular index or a particular sector. In other words, as I'll probably show you in a minute here, if the healthcare insiders all of a sudden start buying heavily, that tells me I want to take a look at healthcare, as opposed to an indicator that looks at all buying and selling of all insiders, which is more of just a general timing of the market. So one of the things I look for here, as you can see, this every once in a while, the insiders get excited and they start buying, right? So let's do a test again. We're going to do a back test. And I usually always like to look at all history, unless I have a very specific reason not to, 1 week. And I'm going to say any reading above, I believe it's 14, basically, 0.14. So I click Run Back Test, and in a moment, this will fill in. You can see the data doesn't start until about 2008. You see all the red dots. What that means is this is when insiders and this indicator, corporate insider buy-sell ratio specifically, incorporates all 500 of the S&P 500 stocks. Any buying or selling from insiders in those 500 companies. And what you see is sometimes they're early, but generally speaking, when you see this type of accumulation, so down here, you start seeing all this buying. The S&P was at about 1,195 in 2011. A few years later, it was up over 1,800, even higher. So again, is the first red dot an automatic buy signal to put 100% of your money in the market? Not necessarily, but when, again, we're talking about weight of the evidence, when you see this kind of a cluster of buying. And remember, when the market's down like this, you're seeing all kinds of negative headlines. So this is the kind of indicator to help you separate the emotion of what's the headline saying from what are the people who know these companies best actually doing with their money. So we saw more recently, let me just get the last 5 years in here. After the COVID sell-off, what happened? The insiders said, wow, this looks like a buying opportunity. So they piled in and we got a nice rally. In 2022, they were a little early. I'm sorry, let me just get this situated the way I want it. Okay, so in 2022, they were a little early, right? They started buying in July. The market didn't really get going until sometime the next year. But again, we're not talking precision market timing. We're talking about analyzing what the smart money is doing. Okay, corporate insiders. Now, again, we can break these out for different indexes. Even though the technology sector has had a great run, take a look at this. The buy-sell ratio for the NASDAQ is actually up in a pretty decent area. All right, so they're not shying away at all. And then again, for the sake of brevity, you can see some of these technology, is up at a high level. But the one I want to highlight, sometimes where you get some really good insights, particularly, I want to mention this is kind of indicator more for investors rather than short-term traders. Okay, so investors, I always define investing as putting money to work, hoping it will grow over time, and trading is buying or selling short in hopes of making money right now. So this is more for long-term investors. But again, let's take a look at the buy-sell ratio for the healthcare industry. We saw some huge buying back here in 2010, 2012, and then a long bull market. Pretty good bull market here. We saw some buying that hasn't really panned out. And then what happened this year? Everybody's talking about what a dog healthcare is, and it was. It was definitely a laggard all year. But what was the smart money doing? They were loading up, and now what's happened in the last couple of months? XLV's gone from 130 to 155. Will it keep going higher? My bet is that it will. In fact, I started buying healthcare based on some of this buying. So again, this is a look at insiders. And then one last thing I want to mention regarding insider, a proprietary indicator that we have is velocity. Not just buying or selling, but it looks at the rate of change of that buying and selling. And a lot of times you get some really great clues. So here's industrials, and anything above like 40 seems to be a decent number for a lot of these. In fact, let me just point out very quickly this article, Under the Radar Insiders. That was you can go back and read that from December 4th, and it's the very indicator I was just talking about. Okay, so industrials, the insiders in the industrial sector started all of a sudden buying a lot and not selling much at all for a 4-week period, and that offers a pretty good clue sometimes. So again, I tend to look at win rate, and you see some pretty good numbers here, and then median returns. Again, these are they're in the eye of the beholder. Maybe you think that's good, maybe you don't, but in terms of weight of the evidence, it says, well, that's probably a good time to take a look at this sector. One other thing I want to point out, just a technical note, a lot of these times in these articles, if you click on this link, it will bring up that test. So you could just hit run test and view the results yourself instead of having to go back and set it up yourself. Okay, that's corporate insider buys. One more. Well, actually, I have many more, but the next one, credit default swaps. It seems like every month I end up mentioning this in the webinar, but there's a very good reason for it. My rule of thumb, when there's trouble in the stock market, there's trouble in credit spreads. And when there's trouble in credit spreads, there's trouble in the stock market. This goes back 2008. You just saw more rising problems with the credit spreads widening out of fear. Market kept going down. And then when you see this huge plunge, does that tell you that it's a good time to get in? More often than not, yes, it does. Let me just look at another time. 2015, right? The market was kind of going up, but then sideways. This started to shoot up. That tells you you're going to have some trouble. Maybe it's a big bear market like 2008. Maybe it's just a period of sideways action. Here, the market went sideways from April of 2015 to about July of 2016. So again, it just kind of helps you adjust your expectations. But when you see this thing start to sell off or decline, it's not really a sell off. And then let's take a look from 2020 on. Right as the COVID thing started happening, this started to shoot up, and you see the market took a huge dive. And then what happened? When this plunged, credit default swaps plunged, it's time to be bullish. 2022, we got a bear market, same kind of action once it starts down. And then if we fast forward, this year was a little interesting. Even before the tariff announcement, we saw this thing start to rise, and that was our clue that there was going to be some trouble. It already started, as a matter of fact, but then once it started back down, that was a huge clue that the tariff was not necessarily going to be a bad thing for the market. So that's credit default swaps. And where are we right now? Well, it just ticked up, but let me zoom out, the whole big spectrum of things. Am I worried about credit spreads right now? Absolutely not. All right. The next one that I wanted to mention, I'm going to do this one very quickly. The fear and greed model. You hear a lot about this one. I don't like it as much as some of the other ones, a couple of them that I'm going to show you. But everything has its day in the sun. So let's talk about, again, let's say backtest this indicator. And all I'm going to do is look for days when this dropped below to 3 or less. So any day where it's below, I'm going to say 3.1, and we click run backtest. And then we wait to see. So is every red dot an automatic buy signal? Not necessarily. However, that's not what I'm going for. Right now, I'm going for weight of the evidence. So if I click multi-time frame results, what I find is the win rates are, well, it's interesting. It's really good through 2 months, and 3 months kind of drops off a little bit after that. So that's good to know. Median return for 3 months, about 7.5%. If you're a short-term trader, maybe that's a good one to keep track of. So if you want to keep track of an indicator, well, I already have this one in my favorites, but you can say, if you don't have it, it'll say add to your favorites. So you click that, you give it a name, and it will save it. And from there, anytime you want, if you want to review it, tools, Backtest Engine 1.0, and you can scroll down to find last signal. And when you click that, any of these things that you've saved, it will go through them and tell you when the last signal was. Okay, so that's find last signal under Backtest 1.0. So that's fear and greed model. Let me just peruse my list here. I don't know if I have time to go through every single one of these, but so if we're looking for reasons to be concerned, well, there's always something, right? There's always something you can look at. Right now, one of the ones we just added, the JK Economic Barometer, and this combines our macro index model and something called LEI sum, which stands for leading indicators, economic indicators. Here's what I want to do. I'm going to go to all. So this goes all the way back into the late 60s. So again, I'm going to make it a logarithmic chart so I can see these fluctuations in the market better. Also, since this is an economic indicator, I'm going to come down here and click recession overlay. So you can see where the recessions actually occurred. And so the history of this is the magic number, quote unquote, is 0.3. Any reading of 0.3 or lower. So down here it was 0.318, and then it ticked in. So you can see that confirms we're in a recession. Sometimes it happens before a recession. Sometimes it happens during the recession, but it's a good sign that we've got some economic headwinds. It's also a good sign when it starts to pick up, because the stock market, of course, anticipates changes in the economy. So let's fast forward a bit and look at more recent history. So in 2000, 2002 bear market, eventually this dropped down and said, okay, we're in economic trouble, and the stock market kept going. Same thing in the 2008 Right now, this indicator is at 0.5. Is that a good number? Does that mean the economy is roaring? No, not at all. Does it mean we're in a recession? Doesn't mean that either. It doesn't, it's not really telling us what it's telling me in my own market-addled mind is the economy is okay, but not great, but we're also not in a recession. So this is one of the ones that I look at on a fairly regular basis. Well, actually once a month, because that's the only, it only updates once a month, which is kind of convenient. So we'll see where it goes from here. If it keeps ticking lower, that's going to be trouble for the stock market and the economy. Okay. Once again, if we're looking for indicators to kind of warn us of potential trouble, I think I might have discussed this one in a recent webinar, but NASDAQ Titanicburg. If you follow the news, a couple of weeks ago, there were a lot of Hindenburg omens, and everybody was talking about Hindenburg omen and the implication. A lot of times on Twitter, you'll see somebody talk about the Hindenburg omen and they'll intimate that it means the stock market's going to crash. It does not mean that the stock market's going to crash. It's a warning sign. So this indicator, NASDAQ Titanicburg, combines Titanic syndrome and Hindenburg omen. And what you're looking for is these big spikes. Now, it's a question of how high is high. Does a reading down here mean something? Does it have to go all the way up here? Those are things you can test out. But basically, what we're looking for is big numbers. So let's backtest this one and see. So I'm going to use, once again, I'm going to use all history. Any day, I'm going to look for any day above 40. If I just wanted the first cross above 40, I could click crossed above 40. I would only get those, but I'm going to take a look at all days. So we're going to get some periods, we're going to get a lot of red dots. So what happened here? Well, in 1990, got up above 40. The S&P went from 238 down to 166 in a couple of months. So that was a decent warning sign. Let me just zoom out a little bit. Now, interestingly, anytime you see a spike of any size, it can be a sign of short-term trouble, right? So this one only got to 35. What'd the market do? Well, we had some sideways action. So again, this will tell you to kind of adjust your expectations in the market. But let's go back to looking at the big spikes, right? This one got all the way up to 41 and went into a big bear market, as you can see, 2000 to 2002. Before the 2008, now again, I talk about how not every red dot, not how every signal from every indicator means automatic action on your part. A lot of times it's important information, but not necessarily a call to action. Here's an example. We got up here in July of 2007. The NASDAQ was at 1956. Was that the end of it? Did the go into an immediate bear market? No, it actually went up another 10%. And then we started getting more readings. And then eventually the stock market had a big sell-off, obviously. Now, interestingly, if we fast forward to the last year, we got a reading above 40. And we haven't really had a big bear market. I'm thinking that this year-long period of sideways action, maybe that was it, along with the tariff sell-off, because that was about close to a 20% decline, maybe more for the NASDAQ. All right, so this warning back in July of 2024, say, well, we didn't get a bear market, that's a lousy signal. But again, note, in June of 24, the NASDAQ was at 19,700. 11 months later, it was unchanged. So that's, again, I look at that as a decent warning sign that something in the market is about to change. The character of the market is about to change. There are so many that I could touch on here. Another one that could flash a warning sign soon. Now, this is one indicator that has been affected by the government shutdown. A lot of the data that we get, some of it didn't get updated. This one has not been updated in a month. So I'm thinking sometime in December or early January, we'll get a new number, and it could be important. So margin is how much money people are borrowing to buy stocks. It's a level of speculation. Okay. And this is the 12-month rate of change in that indicator. And what I have found is when it gets above 50%, it tends to portend trouble in the market. In fact, let me click on bear market overlay so we can see where the bear markets come in, right? So we'll go back to the 60s and 70s. We see this number got above 50%. Shortly thereafter, we had a bear market. Got above 50% back in 1972. We got a bear market. Same thing again. Let's fast forward again to more recent. Heading into the year 2000, people were speculating like crazy. The dot-coms were going to go on forever. This number got up to 80%, and it portended what? A bear market. Same thing in 2007. Just like the last one I showed you, this was early, but turned out to be a useful signal. And then in 2021, when the stock market was doing great, we got up to a high number. And sure enough, in the next year, when inflation took a toll, stock market had a 20% drawdown. Where are we now? Well, as of the last time we've seen data, it's at 45.2%. So it's almost at 50. So this is one I want to keep track of. Maybe every week or every month, I'm going to take a look in here and see if this one crosses above 50%. If it does, am I going to sell everything automatically? As I've been saying, no. Well, what I'm going to do is want to start paying more attention to signs of downside action so I can hedge myself. So that's margin debt, the percentage growth in margin debt. Okay, another one that I show almost every month. I like it better than the fear and greed model myself. Panic euphoria. If we give it 20 years of data, click logarithmic, and we'll do the bear market overlay again. Here's the history of this thing. Here's what's interesting right now. Before a major bear market top, invariably you see euphoria. You see a high number up here, somewhere along the way, sometimes very early. But then you get the bear market. Same thing here. And here you see this. We got the euphoria, and eventually we got a sideways to lower market. Same thing in 2021, right? That dovetailed with the margin debt, same kind of thing. Euphoria, and then we got the bear market. Now, here's what's interesting to me. We've had no euphoria, right? So in this whole bull market that's going on year 4, we still have yet to see euphoria. And my guess, and it's not an absolute, it's just an opinion, is before this bull market is over, we'll see this number up at a high level above 1. So that comes out once a week. So that's an important one to keep track of. Panic euphoria. And another thing is inflation. Okay, people, when the inflation number comes out every month, people dissect those numbers left and right, inside and out. My suggestion, after the numbers are updated, go to the PPI stock market model, and it will tell you what to think about inflation. Basically, I call a reading of 3 very bullish, and when it drops down to 1 or lower, it gets bearish. Okay, so here you see bullish, drops down here, we get a bear market. All right, same thing here and here. And then, of course, in 2021, stock market was doing fine, but inflation started to pick up, and this was giving a warning sign. Very early, as it turns out, but it did warn me that inflation was eventually going to take a toll. So let me just go back to Backtest Edge. Okay, so that's where we are right now. And I'm going to go to my list, and I'm going to look up so I built this into a systematic approach. So anytime it crosses above here, and let me just bring this one up, and I'll show you the rules and then the results. So the setup for this one goes all the way back to the 1920s. We have data going all the way back, so it's interesting. So when this model crosses above 2.5, which it has to do to get to 3, that's an entry signal. And when it crosses below that, so I'm using anything under, even a reading of 2, I'm calling bearish with this particular test. You could also make it 1.5, so that it's got to get all the way down to 1 before you get a signal. But right now, we're just saying if it's not 3, it's bearish. So you're going to get a lot more signals than if you used 1. Let me, so again, now here's one thing to note. Inflation isn't always a factor. There wasn't a lot of inflation in the 2000 to 2002 bear market, but there was enough to get a few signals here. And right now you can see we're on a bull, on a buy signal. Let's look at the results. Now, like I said, this one goes way back. So in the market 80% of the time, so you're only going to be out when there's massive inflation or massive deflation, which is actually very bad too. 84% win rate. Here's the equity curve, hypothetical equity curve using this strategy versus buy and hold. Doesn't mean you can't get drawdowns along the way, but long-term results are pretty good. So long story short, when the inflation number comes out, don't read all about sticky inflation and all those, core components, yada, yada. Just take a look at the PPI model. That's my suggestion. Okay, let's go back. Here we are. Let me just check my time here. Okay, okay, one more. Yeah, one more that I want to show is, and again, this is another one that I seem to show every month, but I think it's really important. You can type it in here if you don't want to scroll all the way through. Sentiment cycle composite. Now, one thing I want to point out about this one, the ones I've showed you before, the bears and the panic euphoria, when the panic euphoria gets up to a high level, technically that's bearish for stocks. That's not the case with the sentiment cycle composite. This one is more of trend following. Okay, so if we go to a logarithmic index, and the cutoff I use generally is minus 0.6. So if it drops below that level, which is down around here, time to be bearish on stocks. And if it gets back above there, it's time to be bullish on stocks. So again, if we zoom into the big bear markets that we saw, when you see this number at a high level, you don't have to worry about sentiment. When you see it start to break down, then it becomes more of a negative. And when it drops below minus 0.6, I call that bearish until it gets back above it. So you kind of see that back and forth. In 2007, 2008, market's starting to roll over, not making much ground. And what's happening to this indicator? It's plunging. That's your clue that there's trouble in the making. So what's going on now? Well, after we came out of this in 2022, we had a nice bull run. And then before the tariff tantrum, so to speak, this was starting to break down a little bit. You can see here, and that was your clue that there was going to be trouble in the market, but it never got down to an actual sell level, minus 0.6. So when this turned around without doing that, that was another clue that the market's going to be in good shape. So right now we're at a very high level. That means the trend is great right now. Am I going to keep an eye on it and look for a drop? Absolutely. Okay. Last thing I want to show you on indicators is for any of the S&P 500 sectors. We have a variety of indicators. I'm just going to arbitrarily pick one. Let's go with XLI component correlation. And I won't even spend much time on this indicator, but just so you know, when it's up high, it tends to be bullish. I'll just leave it at that for today. But the point that I want to make and I want to show you is if you click backtest this indicator, if you want to look at something else for this, all the indicators for XLI will appear here, right? So you can just scroll through these one at a time or just pick and choose and say, okay, I just want to look at this one. What does it look like? What does it tell me? Another thing that I like to do just when I'm analyzing indicators to see if I can find something, I'll set a 200-day moving average, which for some indicators is kind of ridiculous, but for others, it's not so bad. So so if you just peruse this chart for a minute, either something will pop out at you or it won't. If something does, you can take a closer look, right? So one thing we can notice is when it gets down super low, it tends to be a pretty good buying opportunity. Unfortunately, it doesn't happen very often. And again, it's not necessarily precision timing, but it's something to think about. And again, I'm not really trying to show you that specific indicator. I just want to point out that, any of these, you can click on it and you'll get that indicator to pop up. Okay. So I've spent a lot of time on one thing. Let me just run through a few more things before we go to questions. And again, I apologize for not being a complete overview of the market. I'm sorry, of the website. But we'll get there over time. Okay. So crypto, you can probably guess from the status of my hairline, I'm not a big crypto guy, but I do follow and I have traded Bitcoin, mostly the ETFs. But here's an interesting thing I found. Bitcoin, a lot of times sentiment and price action are very closely related. So let's just take a look. The 200-day moving average. I mentioned that a minute ago. Go logarithmic index. And if I click on this blue number and then that moving average, I get just the index. So interesting to note when this got up to a super high level and then started down, what happened? We got a year or more of poor performance for Bitcoin. Same thing here, same thing here, a lot of sideways action. Kind of the same thing here. By the time it broke down, it's at 68,000 about a year later, or I'm not sure the time frame here, from June of 24 to, well, it's only like 4 months. But again, down substantially. Now it's getting down to a low level. If I were going to test this right now, I would go to Backtest Engine and say, what happens when this gets below 45? Or what happens when it's crosses above 45? So that's kind of a way to analyze some of these sentiment indicators. And again, we have that for all of these. So Ethereum, same thing, familiar with Litecoin, so on. So that's just a quick look at that. NASDAQ 100 optics. This is looking at our optics indicator and z-scores, which I don't have time to explain or go into, but basically traders look for low numbers as a sign of being oversold. And when I look at these numbers, I don't see trading signals, I see setups. So let me give an example. We'll take a look at Netflix. Right, so this number is all over the place, right? Well, what happens? Let's go all. And again, I'm going to use my crazy moving average, 200-day. Is that too long? Could be. Maybe I should use a shorter number. But when I look at this, what I find is when this gets down to a low number and turns up, let me just zoom in a little bit to these periods. When this number starts getting down low, if I'm a short-term trader, what this tells me is not to buy. It tells me to look for what is my trigger as a short-term trader. A lot of people, some traders will use a reversal. So once we get down low, we're looking for this thing to pop up. All right, got down low, looking for that pop up for a short-term trade. Same thing here, same thing here. And then in 2023, huge sell-off, down, down, down. Finally, it turned around. When this number is super low, that's telling you when that reversal comes. And I guess that's the important point. This doesn't necessarily tell you exactly when it's going to come, but it tells you that it's coming. So that's just a quick look at that. And right now, are we at a low level for this particular? Well, that's in the eye of the beholder. I would say at least under 45 is what I'm looking at. Global index breadth. Certain things are useful at times that I've found. The percentage of countries, well, you know what? Let me just go to the example I wanted to use. Okay. When the percentage, that's not the one either. Okay. Percentage, the one that I wanted to look at is when the percentage of country ETFs with a rising 200-day moving average. Okay, so if I click on here, what is this going to do for me? I'll go to my setup so I can show you what it's doing. Now I'm actually using this with the S&P 500. All country percent rising, 200-day is rising. And what I've done here is I've made a 50-day moving average. When that 50-day moving average crosses below 30, well, this is actually a sell signal. Okay, I'm getting out in the weeds here. So this is actually looking at sell signals. So here's, you know what, folks, I'm going to abandon this one. I'm going to abandon this example. I got the wrong thing and I don't want to waste your time. So, but basically, again, if you look at the percentage of country ETFs whose 200-day moving average is rising, a rising number is a good sign. It's bullish for the trend on a trend following basis. And then let's see here, trend scores, absolute and relative trend scores. If you're a momentum trader, you'll probably spend a lot of time here. This is looking at basically all stocks. This list is alphabetic, but looking at trend score, relative trend score. What is that? Let's click on, well, we're going to go to Apple since most people know that one. And so what we see is Apple price up here. The blue line is the trend score, and the dark line is the relative trend score. What is that? Well, you can scroll down and read it for yourself. Okay, these are basically automatic objective criteria for both, and it just gives it a number. Rule of thumb, not a trading system or strategy, but when both of these get above 7, so here's Apple, gets above 9 and 7. It's trading at 209, got up to 234 within a couple of days or a week. Doesn't always happen that way. But again, that's what you're basically looking for. So again, here, Apple went to 9 and 7, so it's at 249 a share today, or as of yesterday, 247. So again, you're looking for momentum, you're looking for stocks with high rankings. If you don't want that, if you want to play the short side, you can go to 0 and 0 and find stocks that are performing poorly. You can go to the S&P 500 stocks, the NASDAQ stocks, foreign ETFs, so on and so forth. There's a lot in here that you want to kind of dig into. The other way to use this is to look at these sectors themselves. There's a lot of information here. You can look at the percentage of stocks in a given industry or sector that have a trend and relative trend score. The highest one right now is technology. Okay, if we just look at trend score, the highest one is healthcare. And then this trend score average looks at every stock in that index that's in ticker XLV, the healthcare sector, and says on a scale of 0 to 10, what's the average trend score? All right, let me give you an idea. I'm actually going to look at technology for that one for a specific reason. I wrote a piece a while back. I don't have it in front of me. As an investor, as a swing trader, you're looking for rising values, okay? As a speculator, you're looking for low values. Let me give you an example of how to do that. Backtest here. And I'm going to say, show me any reading below 1.1. So again, all history, observation value 1, period 1 day. And I'm going to say below 1.1. So in other words, the sector is really, every stock is getting beaten down. What do we notice? Clusters of red dots, kind of like the insider buying. Is this an automatic, is the first red dot an automatic buy signal? Not necessarily, but when you see that cluster, it's telling you this thing is getting washed out. All right, so that's that period. Happened again here too soon, right? Too early. But if you're a trader, you're looking for your reversal. Maybe you got in here and stopped yourself out. Maybe you had to do that a few times. But what this is telling you is there's a big rally coming because it's getting washed out. So by the time this was over, XLK went from about $7 a share. I'm sorry, went from $7 a share to about 11. Okay. Anything recent? Let's take a look. No, well, there we are back in 2022. All right. You also, if you look, you're going to find a lot of corporate insider buying in this time frame. So when you see things getting washed out and you see insiders buying and you see high component correlation, some of the things, putting them all together that we've looked at, that's a great buying opportunity. Right now, it's not really telling us much of anything. Okay. Two more things that I just want to cover very quickly. The bond indicator list. So I'm actually going to run over a little bit today. So I hope that's okay, because I still have to get to questions. But I want to show you a few more things here. One of the greatest indicators that you never want to see fire, as I call it, is the 2 and 10-year spread getting above a certain level. right? You can see it here. I don't have time to go into the mechanics of it, but when you see it up here in this range, what happens? Excuse me, big rally in the stock market. Same thing here, same thing here, but it's really ugly when it happens, right? So you just want to be real careful. And then if you're a bond market investor, the one indicator that I would suggest is it's a weekly indicator, the bond cycle model. It doesn't give signals very often. It's very long-term based, but when it gets to one, that means interest rates should be going down. Bond prices, as you see here, should be going up. If we kind of zoom in on the last 10 years, we got a buy signal. In 2019, the 30-year Treasury was trading at 145. And then by the time it gave a sell signal, it was 176. And it's been bearish ever since, and treasuries are trading at 117. So keep an eye on, that's a weekly indicator. Keep an eye on that one. And then if you are a commodities trader, or if you're interested in getting into that, and I talked about that a lot last month, I think the opportunity is going to be there to trade commodities. You can look at ETFs now. You don't have to trade futures or buy bushels of soybeans. You can just trade an ETF that'll track a basket. You want to look at the JK trend following model. And you know what? I am going to take the time to run one more test over here on my back test list. I will type in commodity or part of it. And hopefully I'll type it correctly. Okay, the JK trend following model. Again, let's take a look at the setup to show you exactly what this does. BCOM-SP is the Bloomberg Commodity Spot Price Index, basket of commodities. And what we see is when trend following model is 1, we want to be in. And when it's 0, we want to be out. Nothing too tricky about that. What does that do for us? All right, well, let me make this magically appear. So you can see during significant advances, you'll be in. During choppier times, you might be in and out. But let's take a closer look at the results. It's only in commodities 50% of the time, which seems about right. Only a 61% win rate, but 44% average win, 3% loss. And you look at the equity curve, hypothetical equity curve, $1 in this index only when the model is bullish is the blue line versus buy and hold. So again, that looks like a pretty decent, that's the equity curve. So that's updated once a week. So again, if you're looking at the commodities market right now, this is favorable. So you want to take a look at the JK trend following model. And I think, as I said before, when I started preparing this, I thought, boy, this is really not, I'm really not going to be able to get through all of these things today. So I am going to stop at that point, and I am going to go to some of the questions, and I hope you'll stay with me because I think the questions address some of the, here we go. Let me launch that again. Okay. Let's see, Optimism Index. Well, how does it work and what's the best way to use it? As far as moving average, I think I've showed you how that can apply to a lot of different indicators. Optimism Index, I'm going to give you an example here. Just copied this one from a list that I have. So let me go back into the software. And it's basically, it's a sentiment indicator. Surprise, surprise, right? And so what this particular test is going to do, let me back up once, just intermediate term optimism. Let me just, so we can see what that is before I talk about it. So for any indicator, you can type it in here or you can pull it down here. And when you scroll down, it will tell you what it is. I'm not going to explain all this. I just want to point out where you can find out. Looks at a number of different things, basically. But what I've done for this particular test is I've said anytime it crosses below 20 for the first time in 21 days. So I said 21 days, exclude overlapping, and I click Run Backtest. Let's see what that looks like. And again, you can see it's kind of buying on weakness. So again, you kind of look at this and get a feel for it and say, well, some of these signals look pretty great. Some of them maybe not. What do the numbers say? What do the objective numbers say? So we go to multi-time frame results. And if I'm looking at win rate, I can see very clearly, right? 1 and 2 month win rates of 90%, right? So you can scroll down and kind of see how these go. So if you're a short-term trader or a swing trader, I guess that's more of a swing trade, 1 to 2 months, that looks like a pretty good indicator. So you might want to add that to your favorites. I already have here, but you would click Save to Favorites, give it a name. And like I said, anytime you want to know how it's doing, go back to the Backtest Engine and click Find Last Signal, and it will run through anything you've saved. So that's the Optimism Index. That looks interesting to me. What are the best indicators for a swing trader? I think I've given a lot of examples of that today. Basically, what I look for is oversold followed by a reversal. In other words, I don't want to try to pick the bottom. I don't want to catch the falling safe, so to speak. So I look at some of the indicators that I've mentioned today. There are a lot of them. Anything that looks at oversold. Once you get that oversold reading, look for a reversal, place a stop loss. And one of the hardest things about trading, separating analyzing indicators, which is fun, from real world trading, which can be really hard sometimes, is buying in and then getting stopped out and having to get back in at a later time. It's really hard to do. So anyway, in the coming weeks or months, what key seasonal factors? Basically, the main one is this. Starting in September of the midterm year through about the middle of the pre-election year is go time for the stock market. What typically happens is you get a pullback of some significance during the midterm year. So that's what we're looking at right now. I'm looking at the potential for some choppy market action in the months ahead. That said, the trend following models that I follow are bullish, so I am mostly still bullish. But all of those potential warning signs that I showed you, the sentiment indexes, the margin debt, panic euphoria, if those start to sentiment cycle composite, if that starts to break down, that'll be a clue that I'm going to want to be more defensive between now or the early part of the year and late September, or actually, late September. It's actually October 1st is when the best part of the election cycle kicks in. So you might want to mark that on your calendar. Okay. What is the best way to organize the many disparate pieces of useful information on a one-stop dashboard? Well, that's kind of what the main menu is, but you have to know how to use it. And I apologize that I didn't get through all of it today, but we will in good time. The main thing that I would suggest is indicators. When you find something that you like, add it to your favorites. And then when you go into Backtest Edge, you can add actual entry criteria and exit criteria and save those also. So you have a list of all of your favorite indicators in one place and all of your favorite strategies in another. And there, let me just, as far as like if you, some of the indicators that I showed you, your favorites, you can add some of those there, right? So that might be the place to start. So you can add, let's say you want to follow sentiment cycle composite. Let's see if that's going to break down at some point. First off, so I don't have it. Okay, so I don't have it on the list. So I would add it. Okay, so I would add it. I'm sorry, I had it down here. So you add it here, and that will keep track of all your favorite charts. So you can take a look at that. Also, if you receive the evening digest, it will tell you if your favorite indicators have done something notable that day, something kind of criteria that you put in. So that's probably the best place to take a look for that. And oh, would love to learn how to change the gold and the S&P comparison. Okay, that's not very tricky. Okay, let me give you here on Backtest Edge under My Stuff. You can click My Indicator, and it will bring up a list of anything that you've saved. And if you haven't saved anything, then you can start by creating a new indicator. So for example, here I have crude oil versus the S&P 500. Okay, so I'm sorry, was it S&P gold and S&P? Okay. I think I have that one here somewhere. Let me just take a look. So if I go gold, US dollar, gold, SPY, there we go. So if I click on this one, before I even show you the chart, let me just show you what it's doing. I give it a name, gold SPY weekly. I call it a symbol ratio. There are different choices here, but symbol ratio weekly. You can do daily, weekly, monthly. And all I'm saying is compare gold to SPY. And anytime I want, it's going to bring up this chart. The blue is the S&P 500. Darker color is the gold, and this is the ratio. But what's very useful is to kind of zoom in and zoom out. And so that's a very interesting picture, right? If you look at it here, you say, well, wow, gold is really already gone up a lot against the stock market. Maybe I should get out of gold. But then you look at it with this perspective, and well, it's in the eye of the beholder, but you might look at this and go, I'm going to stick around with my gold position a little longer and see what happens. Now, remember, this line will rise even if they both go down if the stock market goes down more than gold. So that's one thing to keep in mind about ratio charts, but that would be the way to do it. So you could create a new one. You would say create new indicator, and uh, just give it whatever commodity you want, create new, and you could just say, I want silver and SPY down here, or coffee, or crude oil, or any two markets you want. So, and then let me just see if I have any more questions. It does not look like it. So at this point, once again, if you were hoping to get through the entire program today in an hour, I'm sorry, but I think I made the right call in not trying to rush through every single uh, possible iteration. I think in a short period of time, we can get through some more of these in another video and answer all those questions. But I think today you got a pretty good handle on how to use indicators, how to add moving averages to indicators, how to decide whether to say, okay, above or crossed above, things like that. And also getting a handle on whether you're going to use an indicator for swing trading or short-term trading, trend trading, counter trend trading. There's a lot of decisions to be made, so it's important to take a close look at those indicators and figure out the best way for you to use them. And then also we saw in Backtest Edge how to build things into an actual system with an entry and exit criteria, which you can vary along the way. So with that, I'm going to wrap it up and say thank you very much for joining me today, and we'll do it again very soon. Have a great day. Thanks.